All right, let's talk about market structure. The actual skeleton of any price chart. It's supposed to tell us where price is going, but here's the thing. There's a huge problem. Most traders have been taught a version of market structure that's not just incomplete, it's dangerous. So today, we're going to pull back the curtain and see what's really going on.
You've heard it a million times, right? An uptrend is just a series of higher highs and higher lows. It's like trading 101. But what if that super simple definition is the very thing that's holding you back? What if it's not that it's wrong exactly, but what if it's just one tiny piece of a much, much bigger puzzle?
So first up, we're going to completely dismantle what I like to call the structure myth. We're going to dig into why just connecting the dots on your chart so often leads to nothing but frustration and losses. This will set the stage for a much more powerful way of seeing the market. Okay, so this is the textbook definition we all learn. And look, it isn't technically incorrect, but it's kind of like saying a car is just four wheels and an engine. You're missing the entire point of how and why it actually moves. An incomplete understanding leads to incomplete and often pretty costly execution.
Let's be crystal clear about this. Market structure is not a tool. It's not about connecting some random points with a line, and it is definitely not some simple break of structure signal you just sit around and wait for. Here's the key shift you need to make. Structure isn't a tool you use. It's a reflection of something much, much deeper happening behind the scenes.
And this is exactly where that simple logic just completely falls apart. Retail thinking tells us a new high means buy, go long. But be honest, how many times have you seen price punch through a previous high, everyone gets all excited, and then bam, it immediately reverses, trapping every single one of those late buyers? So why does this happen? Because that move wasn't driven by genuine buying pressure. It was designed to trigger orders and create liquidity. Structure alone doesn't drive price. The hunt for liquidity does.
And that right there brings us to the absolute core of this entire explainer. We have to stop looking at just the what, the highs and the lows, and start understanding the why. This section is all about the footprints left behind by the real driver of the market, liquidity.
Okay, so here is our new, much more powerful definition. Market structure is a reflection of order flow. That's the collective buying and selling happening in the market. It's basically a map. It shows you where the big money has already taken liquidity, those pools of orders, and just as importantly, where those pools are still sitting, just waiting to be targeted. I really want you to let this sink in. Every single swing high and swing low on your chart exists for a reason. Price doesn't just turn on a dime randomly. A peak or a valley forms because a massive amount of orders were filled right there, liquidity was hit, and the balance of power shifted. So when a high gets broken, it's not just bullish. It means all the stop-loss orders and the buy orders sitting above that high just got triggered and absorbed. That event fundamentally changes the entire market landscape.
Now, here's where it gets really interesting. Not all structure is created equal. To read this map correctly, you have to understand that there are two totally distinct layers, and confusing them is probably one of the biggest reasons traders get caught on the wrong side of a big move. On one hand, you've got your external structure. Think of these as the major mountain peaks and deep valleys on a high time frame chart. They define the overall directional bias, the primary pressure. But then, on the other hand, you have the internal structure. These are like the smaller hills and dips that happen within those larger moves. This is where you might refine an entry, sure, but if you start trading this internal noise against the big external pressure, well, you're basically trying to swim up a waterfall. The higher time frame structure always carries more weight. So how can we tell the difference between a real break and a fake out? The key is one word: follow through. A liquidity grab is just a quick stab above a high to run stops, and then price snaps back aggressively. But a true structural shift, it clears that liquidity, and then it holds. Price accepts the new level and starts building new structure from there. Always remember, a breakout without continuation is almost always a trap. Okay, let's head into our final section and see how all of this comes together into a brand new way of thinking. This is about shifting your entire mindset from just reacting to patterns to actually anticipating the market's next move like a professional. I'm going to let you in on a secret. The easy money isn't made chasing a trend that's already obvious to everyone. The real, juicy opportunities happen during the transitions. That shift from accumulation, where smart money is quietly buying, into an uptrend.
or from distribution where they're selling into a downtrend. While retail traders are busy chasing continuation, professionals are getting positioned during these messy transitional phases. This is the one that keeps traders trapped in a reactive loop. It's a simple yes or no question that has absolutely no context. It is simply the wrong question to be asking.
So you have to reframe the question. Instead of that, ask yourself this: what liquidity was just taken by that move? This immediately forces you to think about the purpose behind the price action, not just the action itself. This one question shifts your focus from being a simple pattern follower to being a market detective. And here's another common one that's just as flawed. Is this bullish? Is this bearish? This kind of black and white binary thinking is a total trap. The market is rarely, if ever, that simple. A much more powerful question is this: is this move a sign of continuation of the old trend, or is it the beginning of a transition into a new one? You see, that question forces you to analyze intent and context, which is exactly where your head needs to be. So let's wrap this all up at the key takeaways. I need you to forget about thinking of structure as a drawing tool or some kind of confirmation signal. It's not. What it is the map of order flow. It is the footprint of major liquidity events. And most importantly, it's a framework for understanding context, not a crystal ball for predicting the future. When you start to see the chart not as random lines, but as a map of liquidity, price action stops feeling so chaotic and actually starts to make sense. And this right here says it all. Structure shows you what has already happened, but understanding the flow of liquidity, that's what finally explains why it happened. And knowing the why, that is the absolute key to anticipating what might happen next.